Meantime, the S&P's down about 1% right now after the worst day since December. The election day gains have now been lost. NASDAQ's officially in correction territory. Our next guest does suggest shifting to lower growth, lower risk positions. She likes Amazon, NVIDIA, and Broadcom. Joanne Feeney joins us, Advisors Capital Management Partner and Portfolio Manager. Joanne, great to see you. You've been making some of these moves over the last couple of months?
Yeah, that's right. Obviously, there's been plenty of chatter about these coming tariffs, and the president of the United States has the power to impose tariffs, doesn't need congressional help there. So we've been pretty worried about this. And so in our balance strategy, which is designed to be relatively conservative but still deliver good growth over years, needed to have taken a little bit off the table. So we did that over the last couple months. We reduced some of our technology positions, didn't sell out of those, but just reduced exposure. They had a great run. And we added some safer positions, positions that create income, whether that's in Altria. We also continue to really like some of the healthcare names like AbbVie and Johnson & Johnson. It might be boring to be in some of these names, more utilities like Duke Energy. But right now, in this environment of elevated policy risk, not just the tariffs, but also potential government shutdown and global political risks, we think it's wise to just shore up the defensive side of portfolios.
How long do you envision this shift to safety might last, Joanne?
Obviously, we're going to be sensitive to the changing political dynamic. We don't know if these tariffs on Mexico and Canada, China, and potentially new ones on Europe, we don't know how long they'll last. But if the administration wants to engineer a change in manufacturing, that means they're going to be around for quite a long time. And so it's not clear one wants to run back into industries that are in the middle of that. Nevertheless, we still think there's opportunities here for growth, secular growth from AI, from cloud, from cybersecurity. Those things will remain even in a tough environment like the one we're now facing.
I see we're showing some of your moves into Broadcom and NVIDIA. I mean, we are still, even aside from the tariff discussion, dealing with the DeepSeek wrinkle, the maybe lack of ratification on whether these CapEx dollars are going to at least be high margin businesses. Explain why that trade makes sense.
Yeah, we've owned Broadcom for 10 years and NVIDIA for quite a while. So we don't this point raise our positions in those, but we are pretty confident that that growth run is going to last for a long time. Even with something like DeepSeek, that technology was known around the industry before DeepSeek hit the public awareness, and it doesn't really change the narrative. It just means that if you have better and better chips, you're going to be able to do even more, and that's why we have not seen CapEx cuts from the hyperscalers. We see them doubling down. We see Blackwell, the chip from NVIDIA, still in a shortage position and just ramping, and a new one coming at the end of the year. So we do see that as a really strong secular growth opportunity. In fact, if you look at NVIDIA shares here, they're cheap relative to their growth opportunity and relative to the market. So if you're not an owner of NVIDIA and you have a sufficiently long-term perspective, that would be one to take a serious look at this point.
Yeah, you're not the only one today. Citi as well reiterates their buy on NVIDIA as we bounce off 109 and change. Important day, Joanne. Appreciate the clarity and insight. Good to see you. Joanne Feeney.
You bet. Take care.